You know that moment when you're doom scrolling listings at midnight and every house that isn't actively falling apart is somehow 500 grand? And it's like, okay, cool. The kitchen has ugly old counters, the carpet looks like it witnessed a crime, and the basement has that fake wood panel vibe from 1998. But sure, let's call it a starter home. Babe, please. Meanwhile, you're sitting there doing the math on your salary, wondering if you missed some secret memo where everyone else got promoted to can casually afford a house and you didn't. Spoiler, it's not you. It's the math. And the math is rude as hell. I'm Vanessa, and today we're doing something real estate people hate when you do out loud. We're figuring out who can actually afford a $500,000 house in 2026. Not who can get approved, not who can sign the papers. I mean, who can afford it without turning their life into a stress episode with drywall? Because those are very different things, and the bank is not your bestie here. Let's start with the part nobody wants to admit. In a ton of US markets, $500,000 is just normal now. Not luxury, not dream home. Just a regular house with maybe 3 bedrooms, 2 baths, and a yard that can only fit a grill and regret. In places like Denver, Austin, and basically anywhere that's even vaguely near a major city, $500,000 is what people are expected to pay for something that doesn't leak. And the median US household income is around $84,000. So we're asking people making $84,000 to buy homes that cost about 6 times their yearly income. If that sounds unhinged, good. Your instincts are working. But people keep acting like it's fine. The mortgage broker says you're approved. Your parents bought a house on way less. Some TikTok guru is living free with no money down and a ring light. So, what's the problem? The problem is, everyone is casually lying about what affordable means. And the first place people get wrecked is the down payment. Because the old school rule was 20% down. On a $500,000 house, that's $100,000 cash. Let that sit for a second. $100,000. The median savings account in America has about $8,000 in it. So, most people aren't a little short, they're missing the whole bus. And sure, you can say, I'll just save for it. Okay, let's be honest and do that math too. If you make $84,000 a year and somehow manage to save 10% of your gross income, which honestly most people don't, that's $8,400 a year. At that rate, it takes you about 12 years to save $100,000. 12. And that's assuming house prices don't keep climbing, which they absolutely love doing. So most people skip the 20% down and put down 5% or 10% instead. Cute, except now you've unlocked PMI, private mortgage insurance. That's the monthly fee you pay for not having enough money to make the bank feel relaxed. It's basically a wealth penalty, usually somewhere around $200 to $400 a month, depending on the loan. And just so we're clear, that insurance protects the bank, not you. They're worried you might default, so you get to pay extra every month. Love that for us. Now let's talk about the actual mortgage. If you put down 10%, that's $50,000 you somehow scrape together, and you're left with a $450,000 loan. With current interest rates, somewhere around 6% to 7%, depending on your credit, your monthly principal and interest payment lands around $2,750 to $2,850. And that's just the mortgage. That number doesn't include the stuff that makes a house, livable. Add property taxes. Depending on where you are, that can be around $4,000 to $8,000 a year. So let's call it about $500 a month, if we're being generous. Then homeowners insurance, which has gotten wild lately because climate risk is making everything more expensive to insure. That's another $250 to $350 a month, maybe more if your house is in a flood zone, fire zone, storm zone, or just cursed. Then maintenance. The thing everyone ignores until the water heater explodes and you're standing in a puddle at 11:30 p.m. on a Sunday. A decent rule is to budget 1% of the home's value per year for repairs and upkeep. On a $500,000 house, that's $5,000 a year, or about $417 a month. And remember, PMI toss in another $200 to $400. So let's add it up. Mortgage, about $2,850. Taxes, $500. Insurance, $300. Maintenance, $417. Now your monthly housing cost is around $4,367. And that's before anything breaks. Before the HOA gets spicy, before your roof decides to become a problem, before the neighborhood decides to freshen up the streets and bill you for it. Because of course that happens too. Here's where the math gets even less cute. Financial advisors usually say you should not spend more than 28% of your gross monthly income on housing. Banks may approve you if your total debt-to-income ratio stays under 43%. So let's reverse engineer it. If housing costs $4,367 a month, and that's 28% of your income, you'd need to make about $187,000 a year. Even using the looser 43% rule, you still need around $150,000 annually. And now for the little punch in the throat, only about 10% to 20% of U.S. households make $150,000 or more. Which means most American households cannot comfortably afford a $500,000 house, by any reasonable standard. Not maybe if you're frugal, not if you stop buying coffee, just no. But then people ask, okay, but who is actually buying these places? Great question. Some buyers have two strong incomes in high-paying fields. Some have family money. Some are stretching so hard that one layoff or medical bill would blow up the whole setup. Let me show you what that looks like in real life. Imagine a household we'll call the Martins. Two working professionals making a combined $160,000 a year. That's way above median. Solid, upper-middle-class territory. On paper, they should be comfy, right? So they buy the $500,000 house. First, their $160,000 salary sounds amazing, until taxes show up with a clipboard. After federal taxes, state taxes, payroll taxes, and maybe a normal 401k contribution, they're taking home around $9,500 a month. That's the money they actually get to use. Now, subtract the housing cost, $4,367. That leaves them with $5,133 for everything else. 2 car payments, because apparently nobody lives next to anything anymore. There goes $800. Car insurance for 2 vehicles, another $250. Gas, because suburbia is allergic to sidewalks, about $300. Student loans, because degrees were the entry fee for the jobs that got them the mortgage, maybe $600. Health insurance premiums their employers don't fully cover, $400. Groceries for a household trying to eat like adults, $800 if they're careful. Utilities for a bigger house, electricity, water, gas, internet, phones, another $450. Now they've got about $1,533 left. And we still haven't paid for clothes, entertainment, kids' activities, car repairs, medical co-pays, birthday gifts, or the deeply expensive human need to occasionally have fun and not feel like a hostage. Emergency fund? Barely. Retirement beyond the modest 401k? Good luck. A vacation? Maybe in a dream. A random week where nothing goes wrong? Rare. This household is spending 46% of their take-home pay on housing. Not 28%, not even 35%, nearly half. And these aren't irresponsible people. They're not out here buying jet skis and booking Dubai on a whim. They're just trying to live in a house the market keeps telling them is normal. Here's what that actually feels like. It feels like checking your bank app before you buy groceries. It feels like saying no to your kid's field trip because that $35 might need to cover a tire repair later. It feels like lying in bed at 2 a.m. doing mental math about whether you can push off new brakes one more month and just pray. It feels like being one weird expense away from a meltdown. The HVAC goes out? That's $5,000. Someone backs into your car and the deductible is $1,000? Credit card. Your kid needs braces? Congratulations, you're financing teeth like they're a used sedan. And that's for a household making $160,000. Now imagine $120,000, or $100,000, or the actual median income of $84,000. At that level, a $500,000 house isn't tight. It's fantasy. It's not a stretch. It's a financial fairy tale with a 30-year mortgage. And what makes this whole thing so nasty is that the system doesn't care. Sellers list the house at $500,000 because that's what the comps say. Banks approve loans because the loan might not blow up immediately. Agents push buyers to stretch because they get paid when you sign. Nobody in the transaction is paid to tell you, hey, maybe this will absolutely wreck your life. The system is built to get you into the house, not to keep you financially sane after. And once you're in, you're in. You sign the papers, move in your furniture, hang the art, and suddenly you're trapped in a 30-year commitment you can't easily back out of. 6 months later, you can't just go, actually, never mind, without torching your credit and losing money. So people stay. They stay in homes they can't comfortably afford. They stay in jobs they hate because they can't risk a paycheck disruption. They watch their savings disappear and wonder why they're so stressed when they're supposed to be living the dream. Here's the brutal truth. For probably 70% to 80% of American households, a $500,000 home is not affordable, not sustainably, not without taking on a level of risk that would have looked reckless a generation ago. And no, this isn't about personal failure. This isn't because you didn't grind hard enough, or skip enough lattes, or perfect your budgeting spreadsheet. This is a housing market that has completely detached from income reality. Home prices have risen about 400% since 1990. Median household income, roughly 180% over the same time. That gap is the whole story. The math doesn't work. It can't work. And yet, everybody keeps pretending it does. We keep saying homeownership builds wealth, which is technically true, but we skip over the part where you have to survive the mortgage first. We keep telling people to budget better, hustle harder, cut the extras, start a side gig. Babe, you cannot budget your way out of a structural affordability crisis. You can't side hustle your way into a down payment when rent already eats 40% of your paycheck. You can't manifest a lower interest rate. What you can do is look at the actual numbers and make a smart decision. Maybe that means renting and investing the difference. Maybe it means looking at a $350,000 house instead, even if the commute is worse or the yard is smaller. Maybe it means admitting that homeownership in your current market just isn't realistic right now. And that's okay, because nobody tells you this. There is no trophy for buying a house you can't afford. There is no medal for being house poor. The stress of barely scraping together your mortgage every month will absolutely eat the joy right out of getting the keys. The real question is not, can the bank approve me? The real question is, will this house actually improve my life, or just redirect my money to a lender while I panic about property taxes? And for most people, once they run the honest numbers, the answer gets very, very clear. So, what does this mean for you practically? Let's be direct. If you're looking at a $500,000 house and your household income is south of $140,000, pause. Seriously, pause. You are about to make a decision that can dominate the next decade of your life. And maybe not in a cute, cozy way. I don't care what the mortgage broker says you're approved for. I don't care what your agent says is normal in your area. I don't care that your friends somehow made it work. The numbers are the numbers, and they do not care about your feelings or your dream kitchen mood board. And when people ignore this advice, this is what usually happens. They stretch. They tell themselves it'll be fine. Maybe they're banking on a raise that hasn't happened yet. Maybe they're planning to freelance on weekends. Maybe they're just so over renting that they've stopped thinking clearly. So they buy the house. Month 1, they make the payment. It's tight, but okay. Month 2, same thing. Month 4, the car needs brakes. That's $800 they didn't budget for because every dollar is already spoken for. Credit card. Month 7, the AC dies in July. Repair quote, $3,500. No cash, so now it's financed. Month 9, one spouse's hours get cut at work. Suddenly they're short $600 a month. And that emergency fund they were going to build? Yeah, there was never room. That's what house poor feels like. You own the house technically, though, let's be honest, the bank is the one in charge for the next 30 years. But you can't actually live comfortably. You can't maintain it properly. You definitely can't enjoy it. Every surprise becomes a crisis. Every decision gets filtered through one question. Can we still make the mortgage? You become a prisoner in your own house, working to pay for walls. And the really messed up part? We've normalized this misery. We've turned financial desperation into adulting. Oh, you're house poor? Welcome to homeownership, sweetie. Can't furnish 3 rooms? It's part of the journey. Eating cheap noodles because your money went to the mortgage? You're building equity. Like, no. We've collectively decided that struggling to afford basic housing is some kind of rite of passage, instead of what it actually is, a sign the system is broken. The math is screaming at you, but culture keeps whispering, buy anyway. Your parents bought at your age. Sure, but their house was maybe 3 times income, not 6. Your friends are buying. Cool. You have no idea what's happening behind their freshly painted front door. People say renting is throwing money away. Okay, but being unable to pay your mortgage is also throwing money away, just with a lot more panic and worse consequences. So let me give you permission to do something radical. You do not have to play this game. You can look at a $500,000 house, run the real numbers, and decide it's not worth sacrificing your financial stability, your peace of mind, and your ability to build actual wealth. You can keep renting. You can save aggressively. You can wait for a correction. You can look in cheaper markets. You can buy smaller. You can admit that the American dream of homeownership has been warped into something expensive and weird and maybe not even meant for you right now. And that is not a failure. Because real wealth is not owning a house you can barely keep afloat. Real wealth is having margin. Real wealth is being able to invest consistently. Real wealth is not having to choose between fixing the roof and funding retirement. Real wealth is sleeping at night without that little knot in your stomach about next month's payment. That's wealth. Not equity trapped in an asset you can't actually use. The finance world has done a gorgeous little job convincing people that buying is always better, that ownership is always the move, that you should stretch as far as possible because homes always go up. But they're selling a product. They profit when you buy. The bank makes money on the mortgage. The agent makes money on the sale. The insurance company makes money on the policy. Nobody gets paid when you say, nope, this doesn't work for me. So if you're sitting there feeling priced out, like homeownership is slipping away, like you're somehow failing at adulthood because you can't buy a $500,000 house, I need you to hear me clearly. You are not failing. The system is failing you. Home prices have outpaced wages so hard that what used to be normal is now luxury. A $500,000 house is not a starter home. It is not automatically affordable. It is not something you should force if the numbers don't work. Run the real math. Count every cost. Be honest about your income stability. And if it doesn't fit, walk away. There is no shame in saying, this doesn't make sense for me right now. There is no prize for being miserable with a mortgage. The real win is making decisions based on reality, not pressure. On math, not vibes. On your actual financial life, not the one you wish you had. That's how you avoid becoming the cautionary tale in somebody else's foreclosure video. And look, I'm not saying give up on homeownership forever. I'm saying give up on the fantasy that a $500,000 house is magically within reach just because a bank is willing to let you sign your name on the dotted line. Those are wildly different things. The bank's risk tolerance and your ability to actually live your life are not the same calculation. Maybe in 5 years your income doubles. Maybe the market cools and that same house drops to $380,000. Maybe you move somewhere where $500,000 actually buys something decent instead of a fancy apartment with a lawn. But right now, today, with current prices and current incomes, this math is busted for most people. And pretending otherwise doesn't make you hopeful. It makes you a future headline in someone else's foreclosure story. So here's my actual advice. Stop looking at what you qualify for and start looking at what you can genuinely afford without turning your life into a financial tightrope act. Find the number where you can pay the mortgage, handle maintenance, save for emergencies, invest for retirement, and still occasionally enjoy being alive. For most people, that number is nowhere near $500,000. And that's okay. You are not less successful because you're being realistic. You are not behind in life because you refuse to financially drown yourself for quartz countertops. You're just doing the math that way too many people are too emotionally attached to do. The housing market will keep pretending these prices make sense. Banks will keep approving loans that probably shouldn't exist. Real estate agents will keep smiling and saying it's a great time to buy. But you do not have to participate in collective financial chaos just because everyone else is clapping along. Sometimes the smartest move is just noticing the game is rigged and refusing to play it.